Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, where we will help you learn to invest in 15 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined in the room, the one and only, by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. Are you saying the one and only Ren or the one and only room?
Ah, good point.
Yeah.
We'll let the listeners decide.
Yeah.
So you're up in Sydney again, becoming a bit of a theme.
I know. I should consider moving here, maybe.
Yeah, it's good. I like it.
It is. It's good. It's nice and sunny. A bit better than the cold and dreary Melbourne.
Yeah, mate. Well, you've come on a bloody beautiful day. It's been pissing down rain for the last week or so. So
there you go. Lucky me.
Lucky you. So Swans lost.
They did.
Bugger.
Disappointing, but
Yeah.
full credit to the Tigers.
Yes, they're a good team.
Yeah.
They're a good team.
You
But
know.
Swans, they'll have their moment of glory, I'm sure.
Yeah, well, we know Richmond have a habit of disappointing their fans, and after the grand final last year, they have to build their hopes up more before they get disappointed. So I'm backing Richmond top of the table, and then they just tank in the finals.
Really?
2 losses,
First game?
out in straight set.
2 losses. Okay.
Yeah, you need something big to break their hearts these days.
Wow.
As long as it's building up to that, then that's all good.
Okay. Will the Bombers make the finals? That's the question.
Maybe.
I think we're 1 or 2 games too short.
Yeah, although
They
they
say-
looked very good last week.
They looked amazing last
Yeah.
week. They say you need 13 games this season to make the finals, and we have, I think, 7 wins or 6 wins. So we've got to turn it on for the last half of the season.
Well, I've got a bet with one of our listeners down in Melbourne about North Melbourne making the finals.
Okay.
So I'm betting that they aren't. So I'm hoping the Bombers get in.
Take
and
the 8th spot.
Yeah, I win the bet. So
Well, if they don't make it and they come 9th, it's better than what they were expected to finish at the start of the year, which was wooden spoon.
North Melbourne.
Yeah.
Yeah.
They've had a good season. Anyway, moving on, Ren. We're not here to talk. We're not here to talk about footy. We are here to talk stocks. So what we've decided to talk about this week, Ren, is constructing a portfolio. Something we haven't necessarily touched on to this level of detail that we're going to. We've discussed many elements of a portfolio over the past episodes, but not how it all comes together. And for a beginner investor, it's important to start thinking about what you're going to put your money into and formulating a bit of a strategy. So I guess we can start with what is a portfolio.
Yeah. Start from the very beginning.
Yeah.
So when you're thinking about your portfolio, it's not just, what you've put in the market, what equities you've invested in. It's your whole wealth, I guess. Everything, whether you own a house, whether you have money in the bank, a term deposit, what you've got in the market, bonds, everything. And I guess what we're going to talk about today is how you construct all of your money to give you the best returns and at the lowest risk.
And that's a good point. And constructing a portfolio, there's no one set approach. It's completely individual, depending on a variety of things. So, I mean, there's probably 3 things in my mind that you need to consider when constructing a portfolio, being what is your goal, your investing goal, short, long term, whatever it may be. What is the level of risk that you're willing to take overall, and what asset classes would you like to be investing in?
Yeah, 100%.
So let's kick off and go into goals.
Yeah.
So it's important, I think, and if you can make comment on this, Ren, and I'm not sure what you personally do, but I think it's important to set a goal to do with your portfolio, to do with your investing portfolio. Just blindly going into things without any understanding of what you want to get out of it can be a bit risky, I think. But, overall, the goal doesn't have to be specific. You don't have to say, I want to make 20% return over 2 years. The goals can be very broad in my opinion. If you're after growth, if you're after income, if you're just looking to protect your capital, those are sorts of things that you can aim to achieve. Do you have comment on that?
Yeah, I agree. I would almost say that the goal needs to be broader than that, broader than income or growth. It needs to be, what you want to get out of this portfolio.
Yeah.
For a lot of people, it might be, a house deposit in the next 5 years. For some, it might be the ability to retire when they're 40, be able to leave something for their kids.
Yep.
A lot of Americans, they invest to have their kid's college fund.
Yeah.
So it's not so much about the method in which you get there, but it's about, having the correct goals sets your time horizon and sets how much risk you're willing to take to get to where you need to go.
So I guess, as you said, you've given some great examples there of what some goals are. And as you mentioned, risk there. So we can talk about the level of risk that you're willing to take. Within a portfolio construction, you can have varying degrees of risk based on asset class.
Before we get into risk, should we say, do you have a goal?
Do I have a goal?
Yeah.
I do have a goal.
What's your goal? Do you want to share it? Or?
Yeah. So I have multiple goals. I think.
Okay. You've always been a bit of an overachiever.
So I think my ultimate goal is obviously long-term growth that eventually will give me enough income, supplementary income down the track that would really ease the pressure on work outside of investing.
Yeah.
But short-term goals are to create and construct a portfolio that has quite a defensive position, A, to protect my wealth, but also B, to try and actually make some money if and when the share market turns. As you know, I'm fully in belief
you're a bit of a perma-bear.
Something's going to happen. So I want to construct a portfolio that is going to make me money in the downturn. And I also want to have the ability to dollar cost average at a low cost consistently over a long period of time.
Okay.
So that goal that's in one, I'm talking about a lot of things here. I'm talking about time horizon. I'm talking about wealth protection, and I'm also talking about what products that I want to target in that fund. Do you have a goal?
Yeah, mine's not as complicated as yours. I would want the financial freedom to be able to walk away from a job that I don't enjoy.
Nice.
I would want to be able to, when I'm 40, to say I've done enough, I've got enough in the bank that I can live off dividends and income if I need to, and just quit.
Yeah. Great.
Yeah.
I might add that.
Yeah. I think for me, investing is about setting yourself up to have the freedom to be able to make decisions and do what you want to do, whether it's go and study, whether it's travel, whether it's, take time off with the family. The only way that we get to do that is if we set ourselves up now. And so I guess that's my goal. Yeah.
And to achieve that goal, I mean, like the learnings that would go into it would be, I would imagine, great enough that by that stage you'd be a good enough investor to actually support yourself for the rest of your life anyway. And
it's probably one of those things that, like, as you go down that path and you start making money, that then you feel like you can't stop.
Yeah.
Because so many people probably our age think, like, I'm going to be an investment banker or whatever for like 10 years and then I'll quit.
See you later.
And then next minute they're like 60 and they're working 70-hour weeks.
Yeah.
But hopefully that won't happen to me.
No. So good goals, I think, both different goals, but I think of, long-term, very similar goals.
Yeah.
So do you think our goals then, let's talk about risk, do you think our goals then have an effect on the level of risk that we're willing to take?
100%. Now, when we're thinking about risk, a lot of people talk about risk in the context of an individual trade.
Yeah.
So buying, a couple of cent mining stock is considered riskier than, an index fund, the ASX 200 index fund. When you're thinking about your portfolio as a whole, though, you shouldn't think about the risk of individual trades. There's the modern portfolio theory is this theory that's sprung up about quantifying risk across your portfolio. And when you're thinking about it that way, don't think about, I've got 1% of my portfolio and something super high risky, therefore I'm exposed and there's a lot of risk, when across your whole portfolio that you might be actually very defensive.
Yeah.
And when you think of it like that, when you think about the risk across your whole portfolio, then it allows you to make those more speculative bets at one end.
Absolutely. Yeah, totally agree. If you set yourself up well enough that there's products and asset classes in there that historically don't fluctuate so much. You can be reasonably comfortable that you're not going to lose too much money on those, and then depending on your risk appetite, you can put some cash into the more riskier things, asset classes that may give you a better return. I think one thing to note with risk, though, is that it's an interesting one, is that I think your risk tolerance definitely changes over time.
Yep.
And it changes depending on your level of knowledge on asset classes. The more you come to understand how asset classes behave, your tolerance for risk changes. But also as your goals change and you move on through life, I think your risk changes. But that's not to say that you're always going to feel the same about risk.
Yeah.
Do you think you're a risk taker?
I think it depends how you define risk.
Yeah.
So your standard super fund will give you a couple of different options. There'll be a low risk option, a medium risk, and a high risk.
Yeah.
And when you're quantifying risk like that, what they generally mean is high risk is more exposed to equity markets, because obviously they're more volatile. And then low risk is more in cash or bonds and stuff like that. But don't be fooled. Volatility and risk are not the same thing.
No.
Volatility is when prices move a lot. Risk is the risk that you can lose it all.
Yeah.
So in the sense that I'm exposed to equities, I would say I'm high risk. But I think across my whole portfolio, I guess I'm exposed to risk, but I think over the long term, there's a lot riskier plays than just like your vanilla equity market.
I mean, you're not 100% crypto.
No.
And I mean, you just bought the Macquarie notes.
Yeah.
And so I would say that's very low risk.
That's extremely low risk.
Yeah. If you want to just really quickly explain what you did there.
So I bought a hybrid, which is essentially like a bond, but it's traded on the stock exchange.
Mm-hmm.
So it was Macquarie Bank that issued it. And I'm a shareholder in Macquarie, so I could participate, and I thought this would be a good opportunity to learn about bonds and hybrids.
Mm-hmm.
And so what it is, you get payments every quarter, like a bond, but that payment floats based on the bank bill swap rate, so interest rates.
Yeah.
Good opportunity to learn about a different asset class.
Yeah, and so why is it low risk?
Because Macquarie Bank is extremely stable.
Yep.
There's a defined payment every quarter.
Yeah.
And you are with hybrids, you're not actually higher up the debt priority list than equity holders. But if you bought bonds, bond holders, if the company goes bankrupt, get paid back. First. Whereas equity investors don't.
Yeah, right.
So there's less risk that way, because if things do go south for the company, then you're more likely to get
at least money before someone else.
Exactly. So it's considered low risk because the price doesn't fluctuate as much, so it's less volatile, and you're more likely, if things go really pear-shaped, to get paid back at least some of it. Yeah. Nice.
Well, if we can wrap up risk, I just want to sort of summarize, as you said. Yeah.
There's one other thing. So a lot of people have read the book, and if you haven't read the book, Black Swan by Nassim Taleb.
Okay.
Talks about, so he was a currency trader, talks a lot about risk, and what I was saying before about thinking about risk and across your whole portfolio, he made heaps of money during the GFC as a currency trader, but the way he thought about risk was across his whole portfolio. He didn't want to be in the middle, like the sort of vanilla ETF, stuff like that. He was either super conservative or super, super high risk. And he called it the barbell strategy. And it was about 85 to 90% in like US government treasuries, like the safest bond of the safest bond. And then 10 to 15% in like super high leveraged, really risky trades. And so all your upside comes from that 10 to 15%. But, if you lose all of that, you've still got the 85 to 90% in treasuries.
It's a really interesting theory.
Yeah. And he has nothing in between.
Wow.
So
because he just thinks it's a waste of time and effort having your money sitting there?
Yeah. Because
you're either one or the other.
Because the risk in the middle is too high to justify the returns.
Gotcha.
So in that strategy, if he has 85% in US Treasuries, the worst he can do is lose that other 15%.
Yeah.
But because that 15 is super high risk and leveraged,
Could go through the moon.
then that gives you all your upside.
Upside, yeah. Interesting.
So it's an interesting way to think about risk across your portfolio.
Yeah.
Yeah.
No, that's a good one.
Yeah.
I'm going to think about that one.
Yeah.
Risk when thinking about total portfolio is not thinking about, as you said, the individual trades you're making. It's thinking about it at a total view.
Yeah.
Are you high risk, low risk, whatever it may be.
And this, sorry to keep going on about risk, but this is where people always talk about diversification.
Yeah.
Because but the important thing to think about when you're thinking about diversification is not you want to diversify into different risk sources, I guess.
Yes.
So spreading across lots of different equities, you haven't actually diversified because that same problem could come down the line and wipe all the equities out.
Yeah.
What you want to be is exposed to a lot of very disparate risk sources. So, even if something goes wrong in equities or something goes wrong in like the currency markets or something goes wrong in the Australian property market, that's not going to infect the other areas where you've diversified in your portfolio.
Yeah, exactly. Good point. Great segue into asset allocation.
Yeah, here we go.
So the third thing to consider when constructing a portfolio is obviously what you're going to put into that portfolio. So it doesn't always have to be just shares, as you just said, Ren. There are many asset classes that you can invest in, from cash through to commodities, gold and silver, through to exotic shares. I know there was an ETF that we were looking at that followed the price of expensive artwork if you wanted to.
Interesting.
If you wanted to invest in that. So like the range of assets that you can put your money in to diversify, spread your risk is large. What you need to determine is what your preferences are. And obviously your preferences will change over time, but the asset allocation should reflect your goals, I think, in some degree. So it's important that you understand the assets that you're buying into. Obviously, for beginners, you're not going to be putting money into bonds and hybrids and all this sort of stuff straight away because you need to get an understanding of what that is. Ren's been investing for 27 years now, and and he's just bought a hybrid.
And I'm only 25,
so do the maths. So, Ren, what do you want to add to asset allocation? I guess in my mind, if you were to talk to fund managers and stuff, there's primarily, 6 or 7 asset allocations that they always talk about: Australian shares, international shares, Australian listed property, global listed property, commodities, bonds, and then cash. Term deposits and fixed income. So that's sort of like your broad asset classes. Is there anything you want to add to that?
No, they're the main ones. And I think that's a good summary of the different options available. You don't want to just concentrate all in one country, all in one asset type, all in one sector, because you're just asking for trouble. There's something, so Daniel Want, who we interviewed a while ago, talked about this thing called the permanent portfolio, and it was a theory that was come up with like in the 80s or something, and it was a portfolio that is 25% equities, 25% bonds, 25% cash, and 25% gold, and all you would do is rebalance it every year. And
do you want to explain rebalance?
So every year, obviously, those 4 things move based on their prices in that year.
Yeah.
And then every year you sell or buy to take it back to 25%
even about.
Yeah. And so if you just permanently have 25, 25, 25, 25 is your asset allocation across those 4 things, it's considered like, well, the theory was that it would protect you in any situation. If you have high inflation, then gold does really well and your cash does poorly, or if equity markets are booming, then your equity share does really well and your gold might not do so well. But over the long term, as long as you keep rebalancing, you'll have like good returns. And it's been back tested and seems to make sense.
Interesting.
So it's an interesting demonstration of the importance of asset allocation and how spreading it across like varied and different sources of growth, and it reduces your risk and it still allows your portfolio to grow.
I guess the key there is the rebalancing. That's one of the crucial parts
Yes.
of that, is that if you let one asset grow too much, then it becomes too influential, I guess.
Yeah.
So look, we've approached our 15 minutes or less, Ren. So what we're going to do next is, we've done the basics of how to construct, well, not necessarily how to construct a portfolio, but what are the 3 things that you should generally consider when constructing a portfolio. I just want to quickly say that with the asset allocation, you don't freak out and think that you have to have all those assets, because it's just not going to happen unless you've got a heap of money that you're willing to split across all these. It's just not going to happen. The important thing is to start somewhere, and then as you progress, start thinking about what other things you can move into. Like, I've been in stocks and stocks alone and cash for a very long time, and it's only now that we're starting to think about getting into other things.
Yeah.
So what we're going to do in the next episode is now look at our portfolios at an individual level.
Yeah, we'll pull back the curtain.
And we're going to try and, based on the goals, we're going to have a discussion about our portfolio construction and bounce a few ideas off each other. So stay tuned.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.